Good morning, guys. Today we are going to be talking about the actuarial reserving. This is one of the most important features of the field of insurance. And these are our team's members. Now, before we start, let us point out the topics for today. Firstly, we'll be illustrating about the general meaning of the actuarial reserves. Then, we'll be discussing the differences between life and non-life reserves. After that, we'll give you an example of a non-life reserve valuation method. For this work, the chosen method is called chain ladder. And finally, we'll give you a summary of the whole presentation. So let's get started. For the first part, we'll give a whole idea of what the actual reserves actually are. And well, I guess it would be different totally from the other reservations we have experienced. Now, reserves are the amount of money that the insurance companies keep in their hands and set aside as fund to be paid out in the future, especially to the policyholders. The reason for calculating the amount of money to be kept in reserves is due to the fact that the companies get premiums from the policyholders, and they'll never know exactly when they are going to pay the claims back to them in return. And therefore, the reserves come with uncertainty about when and how much they are going to be paid out. It is the actuary's job to consider all relevant factors relating to the amount of money kept by considering all possible inward and outward cash flows. However, the companies themselves need to use the received premiums to pay out their other expenses besides insurance claims as well. And they also have to invest this money somewhere else in order to make the money grow at the same time. For this reason, insurance companies have to carefully calculate the reserves to be in the suitable amount at all time. And if the reserves are too low, the company may not be able to pay out the claims to the customers, resulting in the company's lower rating or even the company's bankruptcy in the worst case scenario, by the way. And on the other hand, if the reserves are too high, the company will lose its chances to invest or use the money for other aspects for the company. Well, since we already know what reserves are, the next question is, are life and non-life reserves the same? And if not, what's the difference? Can the calculation method can be applied to one another? The answer is the calculating method for life insurance and non-life insurance cannot be applied to one another. This statement is true if we consider claims of the life insurance to be about dates of the insured and the claims for non-life insurance not to be about death simply. Also, let's assume that the life insurance companies only have policies of life coverage and non-life insurance companies, on the other hand, only have the policies for non-life coverage. And the reserves for life insurance companies are calculated based on the actual present values, as life insurance is involved with the life of insured, and the uncertainty about the life and date of a person needs to be taken into account, of course. For instance, the mortality rate and the morbidity rates are one of the assumptions being used in calculating the life insurance reserves. Moreover, for some types of life insurance products, the policy also pays out benefits such as the survival and the maturity benefits to the insured. And some policy may have to pay out the dividends to the policyholders. And this kind of benefits and dividends payout as well, cause the increase in the reserve amount. The well-known and well-used method to calculate reserves for life insurance policies is the GPV method. And in contrast, the things we just mentioned, like the mortality rates, the survival and maturity benefits or dividends, do not exist in non-life insurance, as it is not involved with the life of a person. For non-life insurance, they also do not have tables like mortality tables that would have information regarding on the probability of the incident to occur for each person. And due to this, non-life insurance needs to estimate that soon going to be paid out costs from the experience and assumptions. And most of the methods are pattern driven, meaning that the patterns from the past data could indicate how much the claims will have to be paid out in the current year. And another difference is that while main actual assumptions for life insurance are mortality and morbidity rates. The main actual assumptions for the non-life insurance are the assumptions on the expense. I mean, for example, ALAE and ULAE, and expenses used in maintenance. And the method that actuaries use widely in non-life companies is the chain ladder and the expected loss ratio estimation. Anyhow, each method has its own characteristic, and it is, of course, actuary's job to choose which method to be applied for each calculation purpose.
Now, as you can see, we have to introduce you to the method that we think is the most suitable, which is the chain ladder methods. Please know that regardless of the selected methods, valuation must be made based on both paid claims triangles and incurred claims triangles. But let's get into the details of the example method that we have chosen for you. The chain ladder methods, or the CLM, is a popular way that the insurance company estimate their required claim reserves. This method is based on claims development behaviors by assuming the future patterns of the claim development is derived from the past experience will remain stable, and the past claim experience is a good predictor of future outcomes. Thus, in order for these assumptions to hold, data from the past loss experience must be accurate. Also, the methods is mainly used to calculate incurred but not reported, which is IBNR, loss estimated. Using a runoff triangle is of paid losses and losses incurred. There are 7 steps for applying chain ladder methods according to the Jacqueline Federal estimating unpaid claim using the basic technique. The first step is to compile claims data in the development triangles. The second step is to calculate age-to-age factors. The third step is to calculate average of the age-to-age factors. The fourth step is to select the claims development factors. The fifth step is to select the tail factors. The sixth step is to calculate accumulative claim development factors, while the last step is to project ultimate claims. Let's see the example to understand the concept of the methods clearly. As we mentioned, step 1 is to compile claim data in a development triangles. You can see from the table that the data has place as the upside down triangle. Triangulation is based on paid claims. Therefore, the chain ladder produces the total ultimate claims from total loss reserves are determined. Also, know that the cell in the same diagonal axis share the same valuation dates. The second step is to calculate the age-to-age factors. They are determined by calculating the ratio of losses at a subsequent valuation dates. Next is the average of age-to-age factors are calculated as shown on the second diagram. Age-to-age factors are then multiplied together to obtain the cumulative development factors. The results are shown in a third diagram. The next step is to select the tail factors, which is the last column as shown on the slides. The tail factor needs to be selected to bring the latest observation to an ultimate claim figure. After that, we take the calculated cumulative development factors, multiplied by the paid claim reported loss, to project the ultimate loss ratio as the final step. Moreover, you can simplify calculate by IBNR by having the ultimate claim subtracted by the incurred loss. Overall, as this method uses its past experience and pattern to determine how the current and the future claims trend are going to be like. For this reason, the chain ladder method is the most suitable for data with a more development loss data, while the Butterworth-Fagan methods and loss ratio methods are suitable for data with less developed loss data. Therefore, make sure that the data is complete and up to date before choosing what method you want to use. Here's come the last section of our presentation, which is our conclusion. For the calculating method, it could be seen that the difference between the life insurance reserves and the non-life reserves are actually between whether the coverage is for the life of the insurers or not. We know that you already love the summary table, so here you go. We have summarized the main important bits for you on the slides. So for example, the main components of the life and non-life insurance. For life insurance reserves, the mortality rates, expenses, benefit provided, and gross premium are included, where on the other hand, IBNR, ALAE, and ULAE are included for the non-life insurance reserves. 4. The reserve calculations for the non-life insurance policy. It is needed to estimate the reserves from the experience and assumption on each claims. As introduced earlier, we have chosen the chain letter methods as an example. This method is popular since it focuses on the loss experience and pattern of the most recent data. So make sure that you have the available data completed and up to date whenever you use these methods. Otherwise, go for other method instead. There are lots more methods used in the calculating of reserves for non-life insurance company. Like we mentioned, it is the duty of the actuaries like us to select the most appropriate valuation method for each scenario we are facing. Well, we really hope that our presentation could help you understand more about the concept behind the actuarial reserves and the share letter methods. Lastly, we believe that more or less of us will get to experience this role very soon in the future. And that will be all for our presentation. Thank you all for your attention, and please feel free to let us know if you have any question. Thank you.
Thank you.